Hello and welcome to the latest Insider interview. Our guest today is Marcel Stötzel, manager of the Fidelity European Fund. Marcel, thank you very much for coming in.
Thanks for having me, Sam. Great to be here.
So at £4.5 billion in this fund, it's grown very large, it's been very successful, returns have been good. So what's behind its success?
I think it's really two factors. Firstly, we found a process that we think works and we stick to that process. In good times, in bad times, in fair weather and bad weather, we stick to it. And then secondly, I think the real secret sauce is actually the Fidelity analyst team that provides us with, ideas to match and meet our process and philosophy. We have 150 analysts around the world, which is a real kind of army of guys and girls that we can draw on.
And that process then, how are you picking stocks? How is the portfolio managed?
Yeah, so what we're looking for is dividend growers. And people often hear the word dividend and get immediately caught up and think it's a yield fund. But for us, the word growth is equally important to the word dividend. So, we've sliced and diced this data a million which ways, and companies that consistently grow their dividends year in, year out, massively outperform those that don't. And if we can try and get that secret sauce of playing and finding what those companies are that consistently can grow their dividends, we think that's where the edge lies. So, to put some numbers behind it, we will happily own a stock that has a tiny dividend yield, like an Hermes or an ASML, as long as it's growing very materially.
So that dividend growth is a sign of a quality company, is that fair to say?
It's a great question. So I think it's two things. So firstly, the growth angle is a sign that the company is doing well, but then people sometimes say to us, why don't you just use earnings growth, as many people do, and just focus on earnings growth. And for us, the distinction is very important because a company like Total is a great example. Earnings obviously extremely cyclical with the oil price, but that's not an excuse for them to not still consistently grow their dividend. If they have forward planning, if they have the ability to kind of save for a rainy day. And we like that because it means, firstly, that the company actually cares about shareholders enough to do that. And secondly, actually has the forward planning to be able to execute on a consistently growing dividend.
And what's the yield on the fund at the moment then?
We'll be around kind of 10% below the market. So we are more expensive than the market almost always. But I think the key thing that you get for that is you get higher growth, back to the earlier point, you get higher returns. But really, if we're doing our job right, and this is what we saw during COVID, during Russian invasion, we get more consistent dividend growth, i.e. more resilient dividend growth, which is really, what we think the secret sauce is.
Around half of the portfolio has been held for more than 10 years. So is it fair to say that you're a buy and hold investor? And can you talk about some of the stocks you've held for a long time?
It's not the only way to manage money, clearly. Some people do it very differently, and then the market is becoming ever more short-term. Holding periods in the market have come down materially. But for us, we like it because that's the school that we studied at, the Fidelity heritage. We've come through, Sam and myself, as kind of co-portfolio managers, first as analysts, and just really studying in that, long-term school of thinking. In a world, as I said, that's becoming ever more short-term, that's an increasing competitive advantage, we feel. And then secondly, the happy byproduct of that is you lower your transaction costs. And there's only one guaranteed way to lose money in our industry that I've ever found, and that's to trade too much. And we try to do the exact opposite. So, some stocks, Novo, ASML, LVMH, that weren't as much household names as they are now. 10 years ago, or more, we got in and have held happily ever since, which I think tells a good story of, letting your winners run and, getting the really long-term benefits of that, because there were people, 5 years ago who would have, found infinite reasons to sell any of those three, including valuation, including, short-term fundamentals or anything like that. But, we take quite a long-term horizon.
And those are companies you've held for a long time. Are there any new companies in the fund, say over the past 2 or 3 years, that you've introduced and actually plan to hold for the next 10 years or more?
Yeah, there is. So one in particular that comes to mind, we bought about 7-8 months ago, is Epiroc. And what Epiroc does is they do kind of deep underground mining, so the equipment, so think, massive diggers, massive trucks, that kind of thing. And there are only two players that can do that, Epiroc and Sandvik, both Swedish companies. And it's a fantastic industry, firstly, in normal times, because each year that goes by, an ounce of ore gets harder and harder to extract. You've got mines now that are a kilometer more underground. It's much harder than it was 100 years ago, and in 100 years' time, it will be much harder than it is now. So you have that tailwind, in terms of to get the ounce of ore or whatever it is, copper, iron, or whatever, becomes harder and harder. So you've got that structural tailwind. And then what you also have is the new tailwinds from things like electrification. The green energy transition is going to require much more of a wide variety of minerals. And so we think Epiroc historically did 5% top line growth, can now do more like 10% because of this kind of great core business that's being turbocharged, if you'll excuse the pun, by kind of the green transition.
Your portfolio is more expensive than the market on an earnings basis. So why is that, and why is it worth paying up for good quality shares?
I think it's back to the earlier point around the resilience. So if you look through periods of crises, and we've seemed to have had a lot of them over the last few years, COVID, the Russian invasion, and others, our earnings growth, and equally more importantly, almost our dividend growth, was much, much more resilient than the market. And that's typically, the way we like to run the fund. We run it very conservatively. Our goal is to outperform, 1 to 2% post fees per year, but really more than that, to kind of hold and maintain capital in times of crises. So while we are paying more kind of in normal times, or it looks like more in normal times, when that earnings number collapses or that dividend number collapses, that's when our strategy makes up for it.
And Novo Nordics is a top position. It's been in the news recently with its weight loss, kind of management drug.
Yeah.
What makes that company so special, and why have you backed it for such a long time?
Yeah, so it's obviously originated as a diabetes company, and providing insulin and the likes very successfully to a number of people. And along the way, they found that actually the GLP-1s that they were using, the drugs that they were using, had a variety of other benefits beyond just diabetes. Weight loss is the one you touched on. Obesity in and of itself is a massive epidemic. I mean, there's some estimates that there are over 1 billion people worldwide that are suffering from obesity, and curing that in and of itself would have a wide variety of positive implications. But even beyond that, the drug is now being used for things like cardiovascular issues, potentially Parkinson's, Alzheimer's, and a whole variety of other innovative paths that they can go down. So we strongly believe, that the obesity runway is strong and long, but even beyond that, in the same way as they pivoted from insulin and diabetes to obesity, we still think there are a number of other adjacent areas that Novo can pivot to.
And luxury is another big theme. So Hermes, LVMH, L'Oreal could be classified as a luxury stock as well. Mm-hmm. Why do you like that sector? And is it so dependent on, demand from China? And how is that looking at the moment?
I think the real reason why we like it is because of the pricing power. Pricing power is something that we spend a lot of time working on. And particularly, I would argue, in today's environment, it's even more important than it was historically. The reason being, because of inflation, if your cost base is inflating out of your control and your volumes are fixed in the short term, the only way you overcome that is through pricing power. So companies that in the past could have lived, and succeeded without pricing power now are getting found out much more. And I can't think of many industries that have more pricing power than luxury goods. If you take Hermes as an example, you typically have to spend 20,000, 30,000 pounds for the privilege of then spending another 10,000 pounds for a Birkin bag. If you were on that path, which I'm not, full disclosure, but if you were, and you arrive at the store and they tell you it's now 11,000 pounds for the bag, you probably still buy it at that point. And that speaks to the level of pricing power that they have. That's why we really like luxury. China is definitely kind of one of the big worries, although recent kind of results from China, Louis Vuitton reported a few days ago, were actually quite encouraging, particularly as China reopening is kind of finally happening. And this was a big theme last year, and I think the market got a bit disappointed as to how slowly China reopened, but it is now happening much more, and particularly places like Japan and other Asian countries are really seeing a big boost from spending, particularly given luxury goods are often bought, overseas in airports while traveling, that kind of thing. So China is something that we're monitoring and watching, but for now, actually, it seems like it's holding up pretty well as part of that reopening trade.
Marcel, thanks very much. It's been great talking to you.
Thanks a lot for having me, Sam. Much appreciated.
And that's all we've got time for today. You can check out more insider interviews on our YouTube channel, where you can like, comment, and subscribe. See you next time.